You will never buy an IPO after this. Warren Buffett revealed dark truth about IPO. This year, there have been over $100 billion worth of IPOs in the U.S. Companies have rushed to take advantage of investors' high demand, especially for technology businesses and SPACs. In the first week of December alone, the market saw 8 IPOs and 10 SPACs raise $3.9 billion. Today, we're going to talk all about what Warren Buffett just revealed about IPOs. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. Investor demand has been so high that some IPOs have doubled on their first day trading. DoorDash soared 86% in its trading debut, and Airbnb's shares closed their first day up 113%, including so-called green shoe shares. Only time will tell whether or not investors achieved a good deal buying these stocks on their first day of trading. However, more often than not, buying equities at their IPO is not the best course of action for long-term investors. IPO prices. Research conducted by Dimensional Fund Advisors found that across 6,000 IPOs from 1991 to 2018, the average one-year return was less than 4%, underperforming the Russell 2000 by 2% on average. The problem with IPOs is that they are orchestrated to achieve the best result for selling investors. Warren Buffett, Trade's portfolio, once noted that these deals, which are effectively negotiated to achieve the best price for the sellers, put buyers at a disadvantage. The Oracle of Omaha explained this concept at the 2004 annual meeting of Berkshire Hathaway shareholders. An IPO situation more closely approximates a negotiated deal. The seller decides when to come to market in most cases, and they don't pick a time necessarily that's good for you. It's more of a negotiated sale, and negotiated transactions are very hard to get bargains. If you take the houses in Omaha, you know somebody that lives next door to somebody who sold their house for $80,000, and their house is more or less comparable. They're not going to sell it for $50,000. It just doesn't happen. That's what happens in negotiated sales. The CEO of Berkshire Hathaway went on to explain the same does not happen in an auction market. If you have a whole bunch of different owners of one house in Omaha, and they all own a small percentage, they might sell at damn near anything. This is where the opportunity would lie for the patient, long-term investor. Occasionally, Buffett noted, the small pieces of the house would sell at crazy prices. He went on to say, "In my view, you're way more likely to get incredible bargains in the auction market. It's just the nature of things. Sometimes there will be IPOs in terrible markets, and they may come very cheap. But by and large, that is not when IPOs come. They come when the seller thinks that the market is ready for them, and they come with an informed seller thinking it's a pretty good time to go public. And you'll make better buys, in my view, in an auction market." This advice is as important to remember today as it was in 2004. Airbnb is a classic example of this scenario. The company's stock popped over 100% on the day of its IPO, and the firm's market value hit $100 billion. However, earlier this year, the company was in such a mess it borrowed $1 billion at a 12% rate of interest just to stay afloat. As part of this bailout, the private equity sponsors received share warrants that could be exercised at an $18 billion valuation. That was down from an internal valuation of $26 billion at the beginning of March 2020, and the company's valuation peak of $35 billion in 2019. Based on these numbers, it's clear that Airbnb has been able to negotiate a higher valuation for itself than it would have otherwise been able to do. This may or may not pay off for the company's investors, but what is clear is that the business was able to take advantage of investors' mood at the time. That's why IPOs should be viewed with caution. Given the popularity of IPOs among retail investors in the market, it becomes crucial to understand the red and green flags to consider before investing in an IPO. Investors, especially Gen Z and millennials, need to realize that just because the company name is well known in the market doesn't mean it's worth investing in. There are numerous factors that can make the company worthy or unworthy of investment or not. One doesn't have to give in to FOMO, fear of missing out, when investing in the capital market. Instead, you can undertake your research on the company basis the given points and take into account the red flags. Before you decide to invest in the IPO of a company, you need to analyze its business model as part of your research. The investor has to understand how the company is generating revenue and its cost structure. One has to consider the company's core strategy for doing business profitably and its competitive advantage in the market. You also must understand its products and services. Other levers are pricing and costs. If the company seems good based on its business model, then you must continue your research to know it better. Historical financial track record. The following important factor while evaluating whether to invest in a business or not is its historical financial performance. You have to see whether the company has been churning out profits in the last 5 to 6 years or not, whether it's making growth in its sales or not. Profits and growth indicate that the company is stable. Thus, if you're buying an IPO of that company, it means you will also be able to make a profit. But suppose in the past 5 years, the company has been inconsistent with its profit and growth. In that case, it doesn't make much sense to invest in it, as the numbers show inconsistency, and you can't rely on inconsistent numbers for profitability. Valuation. Once you've checked the business model, history, and management of the company, it's time to see its valuation. There are a lot of valuation methods like price to earnings, PE, enterprise value to sales, EV/sales, price to values, etc. It helps in comparing the value of the company with its peers. For instance, the PE of the FMCG company is 45 times average, and if the company going public is asking for 50 PE, then there's no upside for the investor. If PE is 40, there's a scope of growth and profit for the investor. However, apart from valuation, we also have to see growth. The growth factor also decides valuation. Investing in IPOs can be a tricky business, and if investors are not mindful, then following a trend may result in losses. Given that India's retail investors are young and new to the capital market, they must understand what it means to invest in an IPO. Doing a bit of your research can take an investor towards making profits in the market. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye!